For the last 2 years, every buyer I've talked to has said some version of the same thing. I'm going to wait until the Fed cuts rates. Well, on June 17th, the Federal Reserve met, and I need you to hear what they actually said, because the median Fed official no longer expects a cut this year. 9 of the 18 people in that room now expect at least one rate hike before the end of 2026. A hike, not a cut. If you're waiting right now to buy a home, to refinance, to sell, that changes your math. Let me walk you through what happened, why it happened, and most importantly, what it actually means for your mortgage. Because spoiler, it's not as simple as Fed goes up, mortgages go up. So here's the play-by-play. On June 17th, the Fed held its benchmark rate steady at 3.5 to 3.75%. Unanimous vote, 12-0. And notably, this was Kevin Warsh's first meeting as Fed chair. Holding steady sounds boring, right? The headline isn't the decision. The headline is the projection. What Fed watchers call the dot plot. 4 times a year, every Fed official anonymously marks where they think rates should be at by year end. It's basically the Fed showing you its homework. Back in March, the median dot implied a rate cut this year. That was the baseline everyone, including the mortgage market, the bond market, was pricing in. In June, the dots flipped. Here's the breakdown. 9 officials said at least one hike this year. 8 officials said no change. 1 official said a cut, just one. One person in that room still thinks there is a cut coming in 2026. And why is that? Inflation. The Fed raised its own inflation forecast for 2026 from 2.7%, where it was in March, to 3.6% headline, 3.3% core. This is a massive revision in 1 quarter. And here's the stat that jumped out at me. 17 to 18 officials said the risks to inflation are tilted to the upside, meaning almost everyone in that room thinks it's more likely inflation gets worse from here than better. The statement itself even called out supply shocks, especially energy, as a driver. We'll come back to that because oil and the Middle East are a huge part of this story. Now, here's where I need to fix a myth, because this is the single most misunderstood thing in mortgage land. The Fed does not set mortgage rates. The Fed sets the federal funds rate, the overnight rate at which banks charge each other. Your 30-year fixed mortgage is priced off of the bond market, mainly the 10-year treasury and mortgage-backed securities. Those markets are forward-looking. They move on what investors expect to happen, often before the Fed does anything. That's why you'll sometimes see the Fed cut rates and mortgage rates go up the same week. It happened in late 2024. People were furious and confused. The bond market had already priced in the cut and was reacting to what the Fed said about the future. So what does that mean right now? The 30-year fixed mortgage is sitting around 6.5 to 6.6% as of early July. The bond market has already digested most of this hawkish news. That's partly why rates drifted up after the June meeting. But here's the risk. If the Fed actually pulls the trigger on a hike, or if inflation concerns keep coming in hot, the bond market will reprice again. Rates in the high 6s, even pushing to 7, are back on the table in this scenario. And the reverse is also true. If inflation cools faster than the Fed expects, say if oil prices keep falling after the Iran peace framework, mortgage rates can drop even while the Fed sits on its hands. The bond market doesn't wait for permission. So what do you actually do with this? Let me break it down by situation. If you're waiting to buy until rates drop, I want to be straight with you. The wait for 5% plan just took a serious hit. The Fed's own projections say rates end this year higher, not lower. Forecasts for the next few months have the 30-year mortgage staying in the low to mid 6s. Could that be wrong? Absolutely. The Fed's been wrong before, but you'd be betting your housing plans on the one outcome that even the Fed itself no longer expects. Here's the reframe I'm giving my clients. You don't marry the rate, you marry the house. If the payment works at 6.5, 6.6, buy the house. If rates somehow fall to 5.5 next year, you refinance and you win twice. Because you bought before the rate drop wave sends buyers flooding back in and pushes prices up. If you already own and were waiting to refinance, same logic, opposite direction. If you're sitting on a 7, 7.5, or 8% rate from 2023, don't hold out for the perfect bottom. If a refi saves you real money today, the math is the math. Rates going higher from here would mean you missed the window. If you have an adjustable rate mortgage adjusting soon or a home equity line of credit, this is the group that needs to move. HELOCs and adjustable rate products are tied much more directly to the Fed. If the Fed hikes, you feel it almost immediately. If your ARM adjusts in the next 12 months, now is the time to look at locking into a fixed rate mortgage. Message me, this one's genuinely time sensitive. And if you're selling, higher for longer rates means buyers stay payment sensitive. Price right and consider offering a rate buydown instead of a price cut. A 2-1 buydown often costs you less than the price reduction a buyer would ask for, and it solves the buyer's actual problem, which is the monthly payment. 3 things will decide where rates go from here. Put these on your radar. 1, the monthly inflation reports, the CPI and PCE. Every hot print pushes the hike scenario closer. Every cool print pushes it away. Number 2 is oil. The Fed literally named energy supply shocks in its statement. The Iran peace framework from mid-June is the best hope rates have right now. If it holds, inflation pressure eases. If it falls apart, buckle up. 3, the next Fed meeting and the September dot plot. If those 9 hike votes become 12, the bond market will move before the hike ever happens. Look, I know rates might go up is not what you want to hear, but you deserve the real picture, not the hopium. The Fed flipped, so plan accordingly. If you want to know what today's rates actually mean for your payment, your price range, your down payment, your situation, that's literally what I do. Link is in the description below. If this video helped at all, make sure to like and subscribe. I break down what rate news actually means for real buyers every week. And leave a comment below. Are you waiting for rates to drop or are you gonna move? Thank you as always for watching, and I'll see you in the next one.